Okay, welcome back. Sunil Kaul is Global Emerging Market Equity Strategist at Goldman Sachs, and he's now joining us. Sunil, always a pleasure having you with us here on CNBC TV 18. Start by saying congratulations. You, I think, downgraded your view on the India market October last year? And the markets behaved itself in line, I should say, with what your view was. And now you're upgrading your view. You're saying things are turning, things are changing. And obviously, it's not because markets have run away and you're trying to play catch up. It's not. But you are, in that sense, preempting a turn here. So just 1, 2, 3, 4. What are the top reasons, Sunil, for why you're changing your view now?
Listen, Prashant, always a pleasure to talk to you. I would say, look, I think the reason we downgraded is the same reason we are upgrading right now. I think the key reason we downgraded our view a year or so back was because we were expecting growth to slow down and we were expecting earnings downgrades to come through, which is exactly what happened over the course of the last 12 months. Obviously, all the tariff news flow did not help at the margin and people sort of de-risked from India. But I think the primary reason why India underperformed the emerging market so much over the past year, despite, as we have spoken previously, that emerging market has had a great year this year, is because of the earnings slowdown and earnings downgrade cycle. And so I think that the key view we are taking in here is that we think the downgrade cycle has bottomed out. If you look at the earnings integers for MSCI India or Nifty over the last 3 months, they have stabilized. The current reporting season has actually been a tad better than what the street and we were expecting. The season is almost wrapping up. But for MSCI India, we are looking at this quarter about 13% year-on-year earnings growth. The street was expecting 9% earnings growth. So to that extent, it's been a good quarter. We have seen select upgrades in the market in certain sectors. And so the call really here is that we do expect earnings cycle to turn into coming quarters. And a large part of that is also because of the cumulative impact of all the easing both the RBI and the central bank have done over the past year. And some of them, obviously, GST, personal income tax cuts, a host of reforms from RBI, which ease liquidity in the system and allow banks to extend credit. We think, obviously, these things play out with a lag, and we think the lagged impact of all of this easing should start to show up in the numbers. I think that really is the key view there. So upcycle in earnings on the back of growth supportive policy from the government. And at the margin, I think positioning is pretty clean. You've got 30 billion selling from the foreigners over the past year, which is the second largest selling in India's history. All the positioning metrics, all the conversations we have had over the past year shows that people have largely de-risked from India. So positioning is clean. Valuations are still a tad higher, but the premium has shrunk quite a bit. And at current levels in terms of premium for India versus the rest of the Asia or the emerging market pack, India tends to outperform over the next sort of 6 to 12 months on a forward-looking basis. And we did a detailed valuation paper as well, along with the upgrade note, wherein we looked at a variety of different valuation metrics. And the general sense we have is that India can hold on to the current valuations, which are about 23 times, but we think around 21, 22 times should be the fair value for India. So we are not expecting a large de-rating risk on multiples, about 5% in our base case. And so the view really is valuations hold on to current levels more or less, and earnings come through, which is what should drive markets higher. So we are looking for about 14% earnings growth for next year, which is largely in line with what our return expectations are for Nifty at 29,000 target for the end of next year.
So Sunil, 10% EPS growth for this year and 14% for next year. Is that
right.
Good enough for the FIs to come back into the Indian markets at scale?
We have, that's a great question. Look, I think we have a similar number for the broader emerging market pack, and maybe slightly better, but that's also because you have a couple of larger tech-heavy markets where, because of the AI strength, numbers are earnings continue to get upgraded. So those markets, Korea, Taiwan in particular, are printing close to 25-30% earnings growth this year, but also next year expected to be strong. So that's kind of upwardly distorting the numbers a little bit. But for the broader markets overall, we do think India stacks up pretty high after some of those markets. And so we have about 12-13% upside for Asian indices and EM indices overall for the next year. And so India at 14% local returns with 1 or 2%, actually 2 to 3% currency gains and a bit of dividend yield. You're looking at 17-18% dollar upside and probably close to 20% total returns for the market, which should be pretty good for the market, and certainly better for what it has done this year.
All right. Hi, Sunil. Good to see you. And Nigel on this side. What's your view on the mother market, on the US market? Last night, there was some kind of tremors that we saw. Last few days has been a little bit jittery. But to be fair, those markets have seen a beautiful run. The economy has been pretty okay, and the earnings as well have been coming about in the US market. So what's the view, particularly on the AI theme? Do you think that it's getting a little bit into the bubble territory? And, do you expect the US markets to continue to outperform? Or do you expect the emerging markets now to play catch-up?
Look, I think we had another detailed report out just a couple of days back, Nigel, which was looking at our longer-term 10-year expectations for the global markets. And as a house, we have taken a view that the emerging market pack should outperform the U.S. equity markets over the next 10 years. So we have about 6-7%, around 7 to 8% upside annualized annual return for U.S. equity markets and close to 11-12% upside for emerging markets. So we are taking call that the emerging markets should outperform over the next decade the U.S. equity markets. Related to your question around AI, I would say, look, I think we still think that fundamentals are strong in the sector. I think the numbers that have come out from a lot of the AI-related companies, obviously we have the NVIDIA earnings next week, but so far the companies related to the sector that have printed numbers have been pretty strong, both in US, but also the spillovers in Asia have been strong in terms of the tech or the AI-related companies there. As a consequence of that, we have actually raised our earnings numbers for some of those markets which are tech-heavy in the EM region. So I would say fundamentals continue to remain very strong. Obviously, there have been some investor concerns around the overinvestment in capex cycle in AI, but we think those concerns are overdone. There is a lot of positioning and length that has been built up in the sector, and I think what we have seen, I guess, overnight in US, but also last week, is some of these AI wobbles wherein people are taking profits heading into the year end. So that's more a question on valuations, but we do see that the underlying demand trends are still very strong, and we still are quite constructive on the tech and the AI sector overall.
Sunil, hi. Valuations, and I was exactly coming to this because going through your note. So you've still kept the overweights on the other markets that have really stolen the thunder this year, right? China, Japan, and South Korea. South Korea is up some 70%. Today it was down 4%, but otherwise, what a phenomenal move. And in your note, you say, and I quote, that at 23 times price to earnings, valuations in India are still high, but they are justified by a variety of valuation methodologies which have compressed relative to the Asian region. Explain that to us. How is India suddenly looking more moderate on the valuation front at 14% earnings growth?
Yeah, look, I think, as I said, if you look at the valuation metrics, and in the paper we looked at a variety of them, about 6. Some of them are absolute valuation metrics, some of them are relative valuation metrics. But basically, if you look at the how much valuations Indian market is justified based on the growth differential between India, GDP growth differential between India versus the rest of the pack, how much is justified based on the stronger ROEs India has relative to the rest of the world. Obviously, the two markets that are getting premium valuations across the board is US equities and India. And in both cases, they are the markets that have the highest ROEs in the region. And some of that is therefore justified by the stronger profitability on the ROE side as well. We also looked at a variety of other approaches, like the DDM approach, yield gap. It sort of takes into consideration where the rate environment is, but also where the medium-term growth expectations are baked into the market. So all put together, as I said, all of those metrics do point to some moderate valuation correction in India, but it's modest, and on a median basis, only 5% de-rating. So the message was, look, I think given the current state of the market, the current fundamentals, and the growth trajectory of India, you should still expect multiples to hold true. Obviously, there is the domestic bid and the support for equity market, which is to do with the market structure. That also helps at the margin. But also to your question about the valuation premium compressing, that has happened in both directions, right? At the peak a year back, India was trading at peak multiples, which was 25 times. So you have come from 25 times to close to 22 and a half right now as of last night. And so there is a bit of compression that has happened on India's side, but also for the broader region, we were trading at 11, 12 times forward, which has gone to like 15 times forward. So the rest of the region has outperformed and rallied, as you noted. Korea is a case in point. And so from both directions, you have seen the premium collapsing somewhere at 90% plus a year back to around 45% now, which is half of the levels at the peak. And as I said, when we look at the forward-looking returns over 3, 6, 12 months from the current level of premium, India tends to moderately outperform. And so we're not making a lot of a big deal around the valuations point, but I think, as I said at the upfront, the main key reason for the upgrade is that earnings cycle is turning.
Understood. And thank you for explaining it in such detail. Very quickly, Sunil, before we let you go to start your Friday, so you've upgraded India. What are you most bullish on in this market in terms of just key themes?
Look, I think we continue to like the consumer pack as well as financials. We have a variety of consumption sectors in the overweight pack. We still like autos, a little bit of preference towards the mass four-wheelers and the compact SUVs there, given the GST benefits there. We also like the staples pack. A lot of those stocks started to do well after the GST cuts announcement and have given back those gains. So I think the risk reward still looks pretty good. We have upgraded durables, and we also like the broader kind of tourism theme. So all of that is playing into the consumption, and we also think financials should do well in this environment, especially given all the easing measures that the RBI has undertaken, which cumulatively should release about 2 percentage points of capital in terms of total credit into the system. And so I think those two sectors should be the leaders. We continue to like some of the secular themes like defense in there. And the funding areas are largely coming in from the export pack, pharma and IT, as well as industrials, excluding defense, where we still think at the margin there would be moderation in the infrastructure spending from the government. So largely financials and consumer pack is where we are most excited about.
Thank you, Sunil, for joining in. That's Goldman Sachs. Sunil Kaul, 29,000 target on the Nifty, and some optimism is rubbing off. The Nifty is now back above 20.